welcome to the CDG BizCast. I'm your host, Christian Gonzalez, owner of Creativity Design Group, digital marketing firm in Houston, Texas. Today's episode, we're joined by Paul Njoku, the owner and founder of PKN Accounting and Tax Services. Paul started his firm in 2020 after years of experience in corporate tax services, and today he's here to share valuable strategies for small businesses gearing up for the fast approaching April 15 tax deadline. We'll discuss last-minute tax preparation tips, common mistakes to avoid, and how to make the most of this tax season. So let's dive in. Welcome, Paul. It's a pleasure to have you on BizCast for the first time ever. How are you doing today?
I'm doing pretty well. Thank you for having me.
Yes, I'm excited to have you on today's episode because we're going to be educating the small business audience, all of our listeners out there, more about what they can do to truly maximize their tax return. And this not only applies for right now, but we want to have several key takeaways that they can use for future years. If they don't utilize these strategies this year, they'll be good for next year. And I know that a lot of businesses file their tax returns differently depending on their incorporation type. Some file quarterly. Those who just run sole proprietorships and unincorporated partnerships file them yearly. The strategies that we're going to discuss are going to be useful for them every year that they're in business because every year they're going to have to file. Before we cover today's topic, first please tell us more about PKN Accounting and Tax Services and your wonderful story about how you started.
Yeah, not a problem. So how I basically started out my firm, like you had mentioned, I was in corporate America for relatively about 7-8 years. All the while working for those companies, I basically had a very difficult time with getting promoted. And the reason why it was difficult for me to get promoted is because the supervisor or the individuals that I worked under really needed me to stay with their team because for the supervisor's own career and promotions and all the accolades that they deserve, they needed to have quality people under them. So folks like me, they held on to us pretty tightly, and that frustrated the living dog out of me. So I was with Chevron for about 5 years until I saw an opportunity to work for another smaller oil and gas company. And from there, I was actually asked to work on a project. And I thought the project would provide exposure, but I ran into the same issue. So I decided to say, you know what, this is going to be my last time I work for an organization that doesn't necessarily appreciate my services. And so I figured, okay, let me go out and step out on my own. So during the pandemic, that was the prime opportunity for me to actually open up my own firm. And that's how I came up with starting out PKN Accounting Tax Services. I got my CPA license back in 2019. And so from there, I started helping out individuals and small businesses with bridging gaps between their business and financial institutions, teaching people with how to understand the Internal Revenue Code and how best they can maximize and keep their tax deductions. And from there, I just took on anything and everything I felt as though would benefit that individual and also help others.
That's an incredible story. And not only is it an incredible story, but a relatable one. I started CDG back in 2017, pretty much for similar reasons. When I was working for other people, I felt like that there was just lack of opportunities for growth. It seemed like that all the bosses that I had just wanted me to stay in one position and never really get promoted. They were basically just looking for cheap help, and there was just zero opportunities for growth and the lack of respect too. I've worked for several bosses who just did not respect me. They were just unrealistic at times and unreasonable, and a lot of them had this mindset that if you could not do your job better than God could do it, you were a terrible employee that had to be fired. And that's the level of unrealisticness that I was dealing with. Needless to say, I walked away from it and started my own business. And on top of that, I also had several bosses who were just hot-headed and they yelled over every little thing, nitpicked over every little thing, micromanager. So you and me both realized that working for the corporate world was not going to bring us any long-term benefits because I was not going to get promoted at any of my jobs and you saw that you weren't going to get promoted. So we both decided to give ourselves the greatest promotion anybody can give themselves, and that's becoming a business owner and a CEO of your own firm. So congratulations to you on starting PKN Accounting and Tax Services. We need more people just like you in our business world.
Right, definitely. And yeah, I mean, you hit the nail on the head there. Just another one of the issues I also forgot to mention too is, the supervisors that I worked under, I knew more than them. And so whenever I had a question or tried to look for some sort of solutions to resolve a problem, they were not the main resources. They would actually point me to go some other place to handle the issue. If I didn't solve that problem, I was going to be the one that would take the hit for it. And so for that, I was like, okay, no, this isn't even fair.
I remember I also had that same issue once when I worked at a small insurance and tax preparation company over in the West Chase area. This was about 8 years ago. They are no longer there. They've moved. But when I did work there, they wanted my professional opinion on how to revamp their website. I gave them my opinion, and they basically just told me to shut up.
Yeah.
But yes, your story's incredible. I loved how I was able to relate to it, and I know many of our other listeners will be able to relate to it as well, because the majority of small business owners, in my opinion, start their own business for reasons just like that. The lack of growth, the lack of respect, the lack of scalability, and here we are now. We promoted ourselves to something greater than that, and we want to help all of our small business listeners out there get the best out of their tax return. So all of our small business owners out there who have followed the same path that you and I have followed are getting ready to file their taxes. At the time of this episode dropping, the April 15th deadline is only going to be a mere weeks away. So I want to go over some strategies that could help them get the best of it if they have not filed their taxes already. But before we talk about strategies, please share with us some common filing mistakes made by business owners regularly and why they can be problematic.
Yeah. So one of the biggest mistakes really is not filing. Some business owners that I've run into have gone 2, 3, sometimes even 5 or even 6 years without filing. That's one of the biggest mistakes that a business owner can make, because for a lot of the business owners out there that take payments through payment processing systems just like Square or PayPal or Stripe, at the end of the year, you're going to receive what's called a 1099-K, which is one of many different forms of what's called an informational report that's sent to the IRS and you. So if the IRS actually has record of income that you have earned on your business, they will file what's called a substitute return. If they file a substitute return, they will have no regard to any deductions that you may have. Another common mistake is not properly documenting all of your expenses and third-party documentational reports that need to be kept in order for you to paint a story that illustrates exactly what you are doing for your business. At the end of the day, the IRS and you are stuck between what's called being able to prove it beyond a reasonable doubt in order for you to claim a deduction. So there's a few things that you guys are going to have to keep for at least 7 years in most cases as far as maintaining documentation. Another common mistake is not really understanding the business structure of your entity or what business structures you could use for the particular entities that you're going to be utilizing for business transactions. That's pretty big. And then for those that actually work a W-2 job and manage a business, managing their W-4 elections, and even for on the personal side as well, your W-4 elections as far as what your filing status will ultimately be, that's usually a huge common mistake. Oh yeah, then one last one is also not paying an estimated amount of what your tax liability should be by the end of the year. Your actual due date to have your estimated payments done is January 15th. And if you are caught filing with a balance, there's usually a penalty called a non-payment penalty that could range between $300 to $500 extra on top of your bill, in addition to other penalties and fines that the IRS would typically charge as well. If you end up filing a tax return, even if it's on time or not, if you have a balance, you'll end up having to pay extra.
All of that is very useful information. And what surprised me the most is the fact that many business owners don't file a return and they go a maximum of 6 years or more without filing. I'm actually quite shocked at that. What is their reasons for not filing? Is it that they don't know, or maybe it's because they don't know how to do it? What's usually the reasoning behind that?
Well, I mean, the basic one is they don't want to pay taxes. I think that's the biggest one. Other than that, the fear of having to actually go through their documentations, putting things together, trying to find a good preparer, or you could call it procrastination that's turned into some huge form of laziness and all that in a bag of chips. But at the end of the day, it's really the fear of having to pay taxes. That's why a lot of the folks that I've encountered have not filed.
I see now. Yes, while that's understandable, it certainly isn't the legal route to go. I mean, as soon as I started CDG 8 years ago, the first thing I did was consult with my tax preparer over what I needed to do. And deductions, you talked about deductions as well. Too many people don't save receipts. Day one of me starting CDG, I already knew the first thing I needed to do was save receipts for deductions. And right now I have a really fat folder in my drawer full of receipts, all business-related expenses, no personal expenses, all business-related. And I have that ready for next year. You know, I just save them as I go through. Too many people don't keep record of that because they just don't think that they need to do it, in my opinion. But I've learned from other business owners over the years, as they were mentoring me before I started my own business, keep at least 7 years worth of record.
Right. So the burden of having to keep thousands and thousands of receipts is one of the most difficult tasks that people have to run into. So there's actually a silver lining with that. So when you open up a business, you have to treat it as a separate entity from yourself. So just like you said earlier, or you mentioned earlier about not commingling your business and personal items together, you need to have all of your business transactions actually running through an account, a bank account. So the biggest benefit of you actually doing that is you have a third-party documentation recording all of your transactions that you've done for the entire year. So if you don't like keeping all of your receipts, it's okay. You do have a bank account that actually can help with recording most of your transactions. However, you will have to keep receipts on transactions that you deal primarily with cash, because obviously, in order for you to prove beyond a reasonable doubt, you got to be able to show that that transaction actually happened. If you're dealing with cash, you're not going to be able to have a third-party document reflect that, right? So that's why receipts for cash transactions are very, very important. And then as well, certain transactions, you'll probably need to illustrate more of the story than others. So like, for example, if you are purchasing something from Walmart and you have a business that basically doesn't really have a lot of what you have to do as far as like purchasing things from Walmart, you may need a receipt to actually show that you didn't just buy groceries or some toys or some sort of gift for someone else other than an expense for the business. In those cases, that's when an itemized receipt showing exactly what you purchased will actually come in handy. So long story cut short, have all, if not most of your transactions run through a bank as much as possible.
That's been advice that I've heard many experts, just like yourself and others, give to first-time business owners, because too many people are not good at keeping things separate. And my message for everybody out there, for that select few people who do commingle their personal and business expenses, just make sure that you do have all of the required documentation for your expenses. So if you're buying items for your business on your personal account, make sure you keep those receipts so you can truly claim those deductions.
Right.
And so speaking of deductions, my next question for you is a pretty important one. What types of deductions can business owners benefit from greatly, but are often overlooked and therefore not even claimed by business owners?
So generally speaking, with deductions in general, Internal Revenue Code 162, which basically says anything that's ordinary and necessary for your trade or business, you can technically write off. So anything that is ordinary. So for example, if you are baking a cake, you ordinarily have to buy eggs, flour, pots, pans, and whatever you got to do to make the cake, right? Those are the ordinary things that you can obviously write off. Now, the necessary things that are, I guess, more of the indirect expenses that you have with the business of, for example, if you had a state inspector to come and check out your store, the inspector's fee, if you have to pay an accountant to kind of look over your things, what else is there? Property taxes on some of the items that you have, you can definitely write it off. Now, the stuff that people technically overlook with their businesses is actually their vehicles that they are driving all up and down Houston or wherever you live just to kind of take on things for your business. Now, if your miles that you're driving with your car or vehicle is over 51% business use, now we can actually depreciate the value of your car. Your first year, if your car is under 6,000 pounds, you can take what's called a Section 179, which is just a direct expense of your vehicle, but it's only limited to $10,200. But then again, there is a special bonus depreciation that you can take in addition to that $10,000, which will give you up to about $8,000. So your first year, regardless of how much money you've paid towards your car or not, you can take up to $18,200 of an expense your first year that you have your vehicle in your business. Another thing that gets overlooked pretty decently is home office expenses. So if you are operating out of your house on behalf of your business, handling administrative work, storing your inventory or your furniture or whatever else that you have for your business, if you're storing those things in your house, any place in your house other than your kitchen that you can prove that is used exclusively for business, you can actually write off that incremental percentage of maintaining your home as an expense on your business. So some of the things will be the interest on your house, the taxes, your home office association dues, rent if you have that, utility bills, repairs and maintenance. And if you actually own the home that you are operating out of, you can actually take an incremental depreciating value of your home as a deduction on your business. And a lot of the times, if you're operating at a loss, those expenses, unfortunately, will not be recognized in that year. But however, they do get suspended and carried forward into the next year. Then so for another, one of the things that people forget too are the credits. Now, if you have a payroll and you're hiring somebody that receives SNAP, lives in a Section 8 home or an empowerment zone. There is what's called a work opportunity credit. Now, credits are a lot better than deductions. Credits actually reduce your tax liability dollar for dollar. So if you're employing any one of these individuals from those particular areas, oh yeah, one other thing too, if you are also employing anyone who is a veteran that hasn't been employed for over a year or is an ex-felon, then if they work for you over, let's say 20 hours or so, or maybe more, you actually can receive a credit for those hours that you're actually paying those individuals, because now you're actually reducing the burden on the federal government of paying for SNAP and Section 8 housing and all those other programs or whatever. You're actually doing the government a favor by getting them off of those things. So the government is giving you a tax credit for employing those individuals. A lot of people overlook or don't even try to even look at that at all. That's a huge cheat code for a lot of people, especially in the small business arena, because it's very difficult to actually find good help. And usually the individual that they hire may have those particular things that they are receiving at that point in time.
And I didn't even know about these credits myself. But then again, I've been a solopreneur for a while and I haven't had to hire anybody. But that's very important to know. It seems like that the majority of business owners and operators overlook this simply because they're not aware of it. And going back to deductions related to home, one question that I've always been quite curious about would be, what do you do in the case of you're operating your business out of home, but some of your personal expenses also double as business expenses? So for example, if you are subscribed to Comcast Xfinity for cable, obviously watching TV is not a business expense, it's a personal expense. But what if you have internet in your bundle and you're using that internet for both personal use and business use at home, as well as the phone that comes with it?
Yeah, that's a great question. So generally speaking, in the case of home office, if you cannot prove that that particular business is exclusively as a result of your business, then you're going to have to take an incremental percentage of it. Now, in regards to your particular situation, internet. Now, you actually live in your house. So that means you can't necessarily separate the business activities from your personal because you're there. So in that particular instance, even though you do have the extra powered internet for the business, if you only receive one bill, right? And the bill basically has just your name on it, then you're going to have to take an incremental percentage of it. But however, for me, for instance, sometimes when I'm at home doing taxes or other kind of things for my business, I can't afford to have internet eruptions. And then, I have a family of 5 and they're always streaming and watching movies and things like that. So sometimes my internet skips. So I actually pay for a separate service just so I can have an exclusive internet package just for the business. Now, in that particular instance, I can easily prove that this particular bill is for the tax service. So I can write off 100% of that bill as opposed to taking an incremental percentage. So again, at the end of the day, if you're able to prove that the particular expense that you're trying to write off is exclusively for the business, then you can take that. But if not, you're going to have to take a percentage.
And what about itemizing the bill? So let's say someone lives at home, they run their business from home, and their bill from Xfinity is itemized. You've got cable TV on one line, internet on the other line, and phone on the other line. Let's say the cable TV is exclusively for personal use, but the internet and phone are for business use. So what if you just take the prices from that bill, from those line items for internet and phone, and just deduct that, but don't include the TV? Is that also a possible way of doing it as well?
No, because the IRS agent, if they were to look at that, they can challenge you on the reality that, okay, the internet, again, is still on the same bill that you're using for your home. So their argument that they can place in court is that, yeah, you're also using the internet for personal use because, again, this is out of your personal home. And it's not 100% of the time that you are working out of your home for your business. So again, in that particular instance, the answer to that question is no. But if you were to have a totally separate bill that is used exclusively for your home office, in addition to you having a bill for the home, you can write off 100% of that separate bill that's for the business. But for the other one that's just tied to your entire house, again, the argument will be that, okay, this is for your personal abode. So therefore, not 100% of the time that you're there is for the business. Obviously, you'll have working hours, 10 to 5 or whatever. So outside of that time, what else are you obviously doing? You're You're probably surfing your phone, going on the socials, looking up stuff, liking people's Instagrams and things like that, or on the TikTok shopping for things, or, just casually reading articles for personal reasons, most of the time. So again, if you can't exclusively illustrate that this thing is specifically for the business, then you can't take a 100% hit of that as a write-off.
So it's all about making sure that you can truly demonstrate visually that it was a business expense and not a personal expense.
Yes.
And going back to car usage, what's your opinion on the Mile IQ app? And it just tracks where they've driven, their mileage, where they went to and back. And it also allows users to classify which drives were business and which ones were personal drives. What's your opinion on this app? Is it a good way for business owners to keep track of their mileage if they use their car regularly for business use?
Yes, I have no problem with that app. That app is really good. Again, classifying where you started from, where you're going to, and most importantly, the purpose of the trip. That's really good. I like Mile IQ. If you don't have that, then definitely utilize Excel spreadsheets or Google Sheets, if you will. But in addition to the mileage apps, one of the things that actually gets drivers into trouble is this: tracking your miles from your personal abode to the first destination for your business. Now, when you're leaving from your main abode to your first destination, that's what the IRS would call or classify as commuting. You cannot take a deduction for commuter miles. Okay. And so a lot of people miss out on huge deductions that they can take on their car because a lot of their miles that they're recording is commuting. So here's what you got to do to make sure that you maximize on the total amount of miles that you've driven for your business. Because again, you got to be able to prove that 51% of the miles that you drive altogether is for business so that you can take advantage of bigger deductions. So go ahead and commute to your local gas station. Go get a cup of coffee. Go drop off your kids first. Go down the street, talk to a friend, drop off something first. And then from that destination, you now start tracking your miles to your first business place that you're going to. So you want to commute to a very short hop. Go get your gas, go get your coffee, and then from there, go to your first place of destination for your business. Then also, you got to make sure to record the purpose of the trip. If you are an attorney or a practicing lawyer, your purpose can be as vague as attorney-client privilege. Now, for everyone else, you need to be a little bit more explicit. Like if you're in real estate, the purpose of me going to Home Depot is getting air filters to install in the house. Or if you're going to a coffee shop to meet up with a client, say you're going to meet up with a prospective client to discuss this, or a prospective business partner to discuss that, or whatever. You got to make sure to have the purpose illustrated on every trip that you're doing, and make sure not to leave from your house and go directly to the place that you're going to, because you'll miss out on that huge amount of miles that you could record on your mileage log.
Yes, that's very interesting. And there's probably a lot of business owners out there who did not know those specific things, because from what I understand, business owners get a little reckless when it comes to logging their miles. They don't get specific enough. Again, they like to commingle personal and business, which is a huge mistake that too many business owners, whether they're seasoned business owners or they're first-time owners, they continue to make that mistake over and over again. And I'm glad that you were able to shine some light and clarify the proper way it's supposed to be done.
Right. Oh, yeah.
Now, my next question for you is, what is the proper way for business owners to claim their income? So in simplest terms, what types of incoming cash flow should be claimed? I'm sure there are a lot of business owners out there who probably don't claim everything because maybe they weren't sure if it was income that they actually had to claim legally, or, they simply weren't aware of how it works. And this is common with small business owners who just started for the first time. They probably are not sure what should be claimed when they file their first tax return.
Okay, so the definition of income for any business or revenue is anything that is earned. So if you perform a particular job or sell a particular good and you actually transfer the title of that good to your client, you need to record that receipt of the income that you made at that particular point because you've earned it. If you're a cash basis taxpayer, now if you're an accrual basis taxpayer, you're going to record that as revenue the moment you actually complete the service or sell the good, despite you actually receiving the income. So depending on the basis in which you record your revenue, if it's cash or an accrual, you would kind of have to pay attention to those things. And now when it comes to revenue as well, funny enough, I dealt with a client who was undergoing an IRS audit. Every IRS audit, they basically start off with looking at revenue. What they want to do is be able to prove is that, okay, did you issue an invoice? Did you issue a sales receipt? Did you issue some sort of documentation that proves that this particular income that you've claimed is actually revenue? Because it's funny, there's instances where a lot of entrepreneurs try to at least play games meetings with financial institutions. And one of the things that financial institutions want to see is actually the fact that you're actually earning income for your business. And so they would actually take their personal income, add it to the business, and try to act like that's income. For the IRS agent, they want to be able to prove that you're actually managing a hobby as opposed to a business. If you're managing a business, then you should have invoices, sales receipts, bill of sales, some sort of proof showing that you have record of that particular revenue that you're recording on your tax return. So that's the general thing. Now, other than that, income that is reported on informational documentations like a 1099. There's 1099Ks, 1099 MISs, 1099 DIVs, 1099Rs, or 1099 NECs. Any 1099 that you have received, more than likely the IRS has gotten record of that. You had got to make sure you record whatever amount that's shown on that document in your return. So in a nutshell, those are the incomes that you should be recording.
And what can you recommend for all the business owners out there who struggle to keep record of their reporting because they use many different methods of transactions? Maybe they use a couple of different credit card processors, or they use Square, or they take cash. They take all sorts of forms of different payments. And I know some of them, as you said earlier in the episode, that will issue a 1099 form showing how much was received. But for people who struggle to keep track of all this and they want to make sure that they have every single ounce of income recorded from their different payment methods, what can you recommend to help them stay organized?
So utilizing your business bank account is going to be key. Now, one of the things that Fortune 500 companies do, they have many different mechanisms, basically a cost structure with how they kind of manage things. So I always recommend to have multiple checking accounts. So one account, for example, you could have that designated as your receipt account or your receivable account. So that's the account that you want to have your merchant processing engines connected to. So any receipt that comes in, you know for sure all of the deposits that are coming into that account is revenue. And then you would need to have a separate account for your operating expenses. Now you know all of the charges that are coming out from this particular account is for this particular operating account. Now, if you have a credit card, I love credit cards because of the points that you can get. You can designate that credit card for possibly gas or something easy to where you can basically say, okay, if a charge, this account here, if it came out of this account, I know for sure it's revenue. If it came out of this account, then I know for sure it's my operating expenses. If it came out of this account, then I know it's for gas or whatever. And then another account that you definitely should not commingle in any way, shape, or form is your payroll account. Now, one of the biggest revenue engines for the federal government is payroll taxes. So when it comes to payroll taxes, the government, they want it now, like J.G. Whitworth. They need their money right then and there. So if you're running payroll, you should understand exactly how much your payroll is going to cost. Whatever that amount is, you need to transfer it to your payroll account. Leave it there and do not touch it. If you're using a payroll software, which many entrepreneurs should probably look into, like QuickBooks, ADP, Gusto, which is my favorite one, or Paychex, normally your wages, your payroll taxes, and everything that's related to payroll is done on an automated schedule. So once you know the entire cost, which is going to be the gross pay plus the taxes that are supposed to come out, you transfer it to that payroll account and you just leave it there. So to summarize what I was basically trying to say here is you need to have multiple different checking accounts that have designated purposes to help you with organizing all of your transactions that you are incurring for your business.
Right. Small business owners should follow the footsteps of the Fortune 500 companies and use their methods, and they will realize that their financial life will be a lot easier, a lot smoother.
Oh, yeah.
Also, what are some other general strategies that you can share with all of our business owners out there who are listening that could help them get the absolute best out of their tax return? So this is basically anything that we have not covered so far.
Mm-hmm. So the biggest thing is going to be your business structure. So during the pandemic, when I started out, when the federal government was offering PPPs or paycheck protection programs, grants, and other business loans for businesses that were affected by COVID, I understood at that point in time that your business structure was very, very important with you being able to receive those particular funding for the business. In order to expand, those things were very key. Now, if you're operating a sole proprietorship and you have not done it for more than 5 or 6 years or longer, most financial institutions treat you as a side gig. You don't have what's called a going concern. You'll have a going concern issue for them, meaning that they're not sure whenever you you are going to close down, how serious you are about managing your business and things like that. So that's one issue there. So sole proprietorships usually have a difficult time working with financial institutions if they're less than 6 years old or whatever. Another issue that sole proprietors have is they are basically having to deal with 15.1% of what's called self-employment taxes. It's actually one of the biggest burdens or issues that sole proprietors actually do have. So as a sole proprietor, you definitely benefit you to at least have your business incorporated, at least an LLC, and I'll explain why in a moment there. But other than that, you have all the available deductions as most other businesses as well. So as far as any particular benefit in regards to tax write-offs and things like that, there's no real benefit between an LLC and a sole proprietor, other than the fact that, for one, you're considered a more of a serious business owner there. And then plus you have the flexibility of switching things up. So if you're going into business, start out as an LLC by default. So the reason why I like the LLC option, because it's a hybrid between a sole proprietorship and an incorporated business. So one, you get the protection of your personal assets from being seized in the event of somebody wanting to sue you, or if you're working with a financial institution and they make the mistake of just contracting with your LLC, they can only take whatever's in your LLC and not your personal assets. But however, as a single member LLC, you are stuck with dealing with the 15.1% of self-employment taxes. But the cool part about an LLC, you can elect to be treated as what's called a small corporation or an S Corp. Now, an S Corp, you will not be exposed to self-employment taxes in regards to any bottom line income that you make. You only have to pay federal. So there's huge tax savings with switching from a regular LLC to an S Corp. And typically I have a timeline for folks, or just kind of not necessarily a timeline, but like an expectation. So for example, if you have less than $50,000, you can kind of manage it with a LLC. But if you are over 6 figures and your bottom line is really huge, I would definitely recommend switching to an S Corp. And you do that by making an election with the IRS, not the state. So you fill out a form 2553 and send it into the IRS and stay on them and make sure that they have your LLC recognized as an S Corp. So that's really big. Secondly, do your best to try to have all of your assets that you're using in the business in the name of the business. Sometimes, in addition to that, it may be better to lease, because if you're living in a state that charges property taxes, and if they find out or they assume that you actually have assets in your business, you'll actually get a letter labeled as rendition form or something like that. So what they're trying to do is charge you a particular percentage off of the value of all of your assets in the business. So if you have something in the name of the business, you will have to deal with renditions forms. In those particular instances, it's sometimes better to just lease the car to the business. And so in those instances, you don't own the assets, and so you won't have to deal with property taxes from your local county. So that's there. What's the other one? A C corporation. A C corporation, the only time that I would recommend a C corp is if at the end of the day, your income, your personal income, has a tax rate that's above 21%. The C corps, after the Tax Cuts and Jobs Act that Trump had put in, now C corps are taxed at a flat rate of 21%. That's a major cheat code for a lot of individuals that make well over millions of dollars. And so switching to the C corp in those instances are usually the best option for them. However, unlike the LLCs and the S corps and the sole proprietorships, you can't withdraw money from a C corp without incurring taxes on those withdrawals as a dividend or whatever. So you just have to kind of be cognizant with that. Align yourself with the business so things will make sense in that regard. And then one other thing that a lot of incorporated business owners do not necessarily take advantage of is the annual meeting that you're supposed to have. Those annual meetings technically can be had just about anywhere. So some of the things that people have seen on social media about folks having an annual meeting in like Dubai or Hawaii or whatever, that's actually true. So if you are going to any of these places with your employees could be your kids if they're of age, obviously, or your business partner if they're a spouse. When you're having it in a different place, you can actually have that whole trip written off as long as every single day the days that you are there, you're having a business purpose for that day. So for example, if you're going to Hawaii with your kids one day, obviously, as long as you guys have a meeting talking about the directions of the company, that whole day can be written off. Obviously, the flight to and the days that you're doing business things as far as like hotel fees, food, and things like that. Major thing that you'll need there is documentation. You'll need to document the minutes of the meetings. You need to document who's at the meetings and their titles of the meetings and things like that. So yeah, annual meetings is very big. If you're an incorporated business, you're supposed to have one at least once a year. So take advantage of those. And if you're incorporating or if you're utilizing the services of your kids or your spouse, align your date night with your executive meetings and everything will be okay as long as you document as well.
Right. It's all about making sure that everything is kept separate for one thing, and ensuring that if you are going to claim an expense as a business expense, in the example you gave, the trip to Hawaii, if there is no annual meeting, then it's basically a personal expense and can't count as a business expense. So my message to everybody out there is listening is be honest, upfront, transparent. Make sure you have all of your documentation and don't try to cheat on your taxes.
Yeah, don't try to cheat, because at the end of the day, well, I'll say this too. At the end of the day, you have to be able to prove beyond a reasonable doubt that that particular business expense was ordinary and necessary for your trade or business. So there's a lot of instances where you actually take a deduction for something that actually happened, but don't have the proper deduction. So the deductions that end up ruling the day, if it's from a third party, that is the best, which is why I was trying to hammer home with making sure that a lot of your expenses are being reported on bank statements as opposed to you recording them on your particular Excel spreadsheets. Keeping receipts from car dealerships that basically show your annual mileages for the year. So like, for example, if you change your oil or car registration, it's going to report the total amount of miles you've driven at that particular point. So in addition to your mileage IQ, you want to have a picture that shows exactly how many miles you've driven for the year. And if you have an invoice or a receipt that basically covers an expense that you had incurred and recorded on your tax return, those are big. That coupled with your meals log or mileage log or anything like that, that actually helps. So third-party documentation, keep those. Do your very best to try to illustrate or paint the picture that this particular expense was ordinary, necessary for your business, and definitely consult with an experienced CPA or enrolled agent or tax preparer that's been out there doing this for several years. Reputation is very key too. So a lot of mistakes that I've also incurred or actually seen from a lot of the folks that come into me is working with somebody that's very inexperienced or has some sort of bad intentions when preparing tax returns. It's very important that you speak with somebody that's very honest and experienced and making sure that you're in the best position to look great.
Yes, unfortunately, there are tax preparers and accountants out there who are inexperienced, or they just don't know what they're doing, or they have nefarious intentions. Maybe they want to purposely help their customers cheat on their taxes. And again, don't ever do that. To all of our listeners out there, don't ever try to cheat on your taxes, because Uncle Sam will come and find you. Always make sure that you're as transparent as you possibly can be. Take all the advice that Paul has shared with you today and apply it. Make sure that you are doing everything by the book and you are ready for when that deadline comes. And also, not only with taxes, but when it comes to accounting and bookkeeping, make sure you are keeping proper books. You don't want to be another Enron, because we all know what happened to them.
Oh, yeah. Even with that one, they were basically trying to cheat all their stakeholders out of their funds, because again, if you own a share in a company, you're equally at risk of losing your investment as the owners themselves. And so one of the things that corporations try to do is they rely on their financial statements to increase the value of their assets, to reel people in with their investments. And then when it's discovered that their company is not as valued as they would like to illustrate or make it out to seem, then all of a sudden people are losing their money just like the company. So yeah, Enron was very interesting with trying to take care of that too. And reputation is key. I don't know if you remember the Arthur Anderson. That was the auditing company that managed that company. Because of their comminglement with Enron, that accounting firm closed down as well with Enron too. Horrible.
Right. And the other end result was that the government passed the Sarbanes-Oxley Act to make sure that transparency is kept open and that it's required, that basically to make sure that this never happens again at any other publicly traded companies.
Oh yeah, that's correct.
Well, Paul, you shared a lot of great information with our small business listeners today, and I hope that based on what they've heard, as I said a minute ago, they will be able to apply what they've learned in today's episode to their tax returns and see the best results if they're able to truly maximize it this season. With the deadline just weeks away, we want to see them truly get the best out of it. And like you said, if they need a tax preparer who is great, who knows what they're doing, they're listening to him talk right now.
Awesome. Thank you so much for that. And hey, if you need more time, there is that automatic extension IRS does offer. If you have access to TurboTax or Free Tax USA, that's another free engine. File an extension, give yourself 6 months to kind of get your things together. Don't rush to file something you're not sure of. So give yourself some time. And then if you end up having to file and you realize that there was something you left off, you do have 3 years to file an amended tax return if you're expected to receive some sort of refund. But however, if you're not expected to get a refund, don't worry about it. You can still file an amended return even after the 3-year mark. Just know that if you're filing an amended return and the 3-year statute of limitations is already wrapped up. Like, for example, for this year, you have 2022. 2022 is on the chopping block. So if you don't file 2022 now as an amendment or that year and you're expected to refund, you're going to lose it. So just want to put that out there as well.
Yes, it's important to keep that extension in mind because you don't want to rush things either, because when you rush things, it just creates more mistakes. So if you're not sure about something, keep the extension in mind, but also don't forget to consult with an expert as well.
Oh yeah, most definitely.
I think we are going to go ahead and wrap up, but before we do, Paul, is there anything else that you would like to share with our listeners that you didn't mention earlier or you would like to inform them about?
No, nothing really. Taking on the entrepreneur skill set is very impressive. It's very tasking. One of the things that I would definitely want you guys to understand is go ahead and seek professional advice. And what I mean by professional advice, I mean an actual licensed individual. Trying to take a lot of advice you see on Instagram, social media, and TikTok can be very, very dangerous, especially if you're thinking that you can run off and take these huge deductions because you bought this G-Wagon that's over 6,000 pounds and I can write the whole thing off kind of deal. Don't take your advice off of social media. Even the professionals that are on social media, take their advice with a grain of salt. Make sure you sit down with somebody that can explain in detail how exactly that particular piece of advice you heard can actually benefit you or not. So that's the only thing I got to share with you guys. Other than that, kudos to y'all for taking on investing in yourself. It's really important that you got to do that. I think one of the biggest things that anyone can do is not just invest in companies, but more especially invest in yourself.
That's right. Invest in yourself. And yes, don't get your advice from social media. I mean, you remember last year, TikTok was encouraging people to steal money right from Chase Bank?
Oh, yeah. I remember that.
Again, that proves my point. Case closed. Don't get all your advice from social media. Consult with an expert. And also, the world of entrepreneurship is a fun one. It can be a roller coaster at times, but it's a great one, especially when you can realize that you have more freedom versus working in the corporate world, as you and me both can relate to. And I just want to say, Paul, congratulations to 5 years in business since the pandemic. You started PKN right in the middle of the pandemic when businesses were struggling. You didn't cower and run away. You decided, no, I'm jumping in. I'm going to be a warrior about it, and I am going to start my own business and serve my clients the way they deserve to be served, with 5-star service.
Oh yeah, it's been fun.
It certainly has been. But thank you once again for joining me on BizCast. I learned a lot of new things. I hope a lot of our listeners will have learned a lot of new things and that they will take this advice and apply it right now as the clock is ticking, the deadline is coming, unless you file for an extension. But I think we've shared a lot of great information to help make sure that business owners get the best out of their tax returns this year and for future years. Thank you, Paul. Thank you for coming on BizCast. It was a privilege and a pleasure, and I certainly hope to have you back again for future episodes.
Oh, not a problem. Thank you for having me. It was great.
I just want to say thank you once again, Paul, for sharing all this valuable information that will help our small business owners get the best out of their tax return this year. Before we go, please share with us, where can people find you and how can they get a consultation with you if they need help? Do you serve clients nationwide?
Yeah, I serve clients nationwide. Definitely do that. Best way to reach me is going to be my website, www.pknaccounting.com. Leave your contact information there. Let me know a little bit about what you need and how exactly you met me. Then we can go ahead and get you signed up for a 30-minute consultation. You can also email me at info@PKN Accounting. That again is info@PKN Accounting. I am on Instagram, but however, I don't really pay too much attention to DMs, but the best way to get me is going to be my email address.
Thank you, Paul. I hope that many of our listeners will contact you if they have any questions because you're available, you serve clients nationwide, and our podcast is syndicated nationally. Even though we are local Houston-based businesses, just like you, I also serve my clients nationwide. It's all about scalability. Thank you for listening to the CDG BizCast. Small business owners, go out there and take on the world.